Jeff, let's play a fun game. What do you say?
I love fun games.
This is an extraordinarily fun one. Berkshire Hathaway, Warren Buffett, is retiring as CEO at the end of the year. That means one of their main capital allocators, stock pickers, is leaving. They're going to need more stock pickers.
Let's offer our services.
Right, right. Let's each bring a stock that we would introduce to the Berkshire portfolio if Buffett hired us to join his investing team.
All right, let's do it.
Before we do, this video is sponsored by The Motley Fool. If you're looking for more great stock ideas, we got two doozies here. One that kind of feels very Buffett, one that feels like it should be a Buffett, but by the traditional Buffett ideas and measures doesn't really fit. Those are two good ones. But The Motley Fool, we have a special offer for you. Go to fool.com/unscripted. Go to fool.com/unscripted. You can get access to The Motley Fool's 10 best stocks to buy right now. All right, Jeff, or who's going to go first here, you or me?
Do yours first. I think yours is the more Buffett-esque, typical Buffett, so we should do yours first.
It is. So there are parts of it that aren't really traditional Buffett because he's not known for buying businesses that are kind of struggling and looking for a turnaround. But we do know he loves valuation, especially when you can buy a really good quality business with a long history of doing well, has powerful brands, has other economic moats. And I think that's the case for Target. We've heard Buffett talk about Walmart in the past. That's an investment that he missed, and he missed it over 3/8 on the price, his price, right? And missed hundreds and hundreds of percents in gains. So obviously Target's a different business today. It's very mature. It's been around for a long time. It's paid and grown a dividend every year for decades and decades at this point. But the business has really struggled coming out of the pandemic. Jeff, if we go back to the pandemic, it was one of the winners in that first year and a half because they had a good e-commerce platform in place. And then they've run into some problems coming out of that. They had some inventory challenges where they had way too much apparel and not enough other things directly after the pandemic. Inflation has affected them. Interest rates have affected them. There have been some social issues that have gotten tied up into kind of politics and personality politics that have affected their business as well in some negative ways. All that to say, the business has certainly missed the mark in terms of expectations. Now, here's where I think it would be a good fit for Berkshire's portfolio. A couple of things that we do know. We know Berkshire likes to own businesses that do have durable moats, economic moats, things that are strong. And Target's brand is still, despite all of the challenges, it's still a very, very durable brand, has plenty of loyal customers. It seems like right now, some of the challenges are more macroeconomic. It's not a Walmart on the low cost end, and it's not on the higher end either, where we're seeing retailers having success from upper income spenders that have plenty of disposable income. So it seems like they're kind of missing the mark in the middle there. Eventually, the cycle is going to turn and the business, I think, is going to be able to bounce back. They're a huge buyer, so they do have some cost advantages with some of their brands, their private label products. They can get a little bit of a premium and boost their margins a little bit. A couple of other things that are really compelling that we like in the Berkshire portfolio. We like dividends. Berkshire doesn't want to pay a dividend because we think we're really good at allocating capital. You see, I'm really stepping into that.
Yeah, I like the
Berkshire
use
now
of
mode,
we.
right?
Yeah, that's nice. That's nice.
Yeah. So, but we love to get dividends, and the dividend yield right now is over 5%. I feel like the dividend is pretty safe within the company's existing cash flows, being able to continue to support the payout. We might really have to be careful about growing it going forward, but that's okay. I think, again, is having a safe dividend is really important. So the yield is 5%. So that's already starting to help us hit some of our benchmarks on the expected returns that we're going to get. Now, the other thing is, I think from a valuation perspective, companies' earnings are very, very beat down. The stock is beaten down even more. And as a result, we can buy Target for about 10 times trailing earnings. Now, I'm going to look over the past decade just to show you earnings have recovered a little bit, but are still below the peak levels. And I'm willing to predict that over the next 5+ years, Target's going to be able to grow its earnings 4 or 5% a year. And if the company can grow earnings per share 4 or 5% a year, that's a pretty low bar. We take that earnings per share growth of 4 or 5% a year, combine that with a 5% dividend yield, and that margin of safety of paying 10 times earnings today, that gets us a 10% in total return right off the bat there, not counting on that multiple, earnings multiple moving higher. I think the earnings multiple can move higher, uh, which would boost our returns even more. So that's my pitch. I think Target would be the first stock I would add to the Berkshire portfolio. What you got, Jeff?
You talked a lot about valuation and a beaten down stock in your pitch. I'm bringing Mercado Libre to the table, ticker symbol MELI. This is not a valuation play. Mercado Libre currently trades for around 62 times earnings. So if Buffett himself were making this pick, I don't think this would be on his short list. However, you and I are now in charge of this pick. So in the spirit of Charlie Munger, successfully convincing Buffett over time to consider, paying a little bit more for an outstanding business, I think this falls into that bucket, but maybe updated for 2025. So Mercado Libre, if you and I were just talking before we hit record, if you just go back and look at the quarterly results over really any period of time, they're outstanding. They've really never stubbed their toe. And it's both sides of the business. It's the e-commerce platform, the biggest e-commerce platform in Latin America, which is a fast-growing emerging market. They are the leading fintech platform in Latin America. And no matter what part of that two-sided piece of the business you're looking at, the growth is astounding. Like, so overall revenue growth in the last reported quarter, which was Q2 of 2025, was 34%. And it's strong on both ends. Commerce revenue, which is the e-commerce platform, was 29%. Fintech was 40%. And all of the metrics you'd want to keep an eye on in both of these businesses are growing at equally impressive amounts. So just sticking to the e-commerce side for a moment, gross merchandise volume, which is just the total amount of dollars that transacts over the platform, that was up 21% year over year. Items sold up 31%. And these are not outlier numbers, Jason. This is basically what they do every single quarter, year after year. Flipping to the fintech side, total payment volume up 39%. The credit portfolio up 91%. They're doing a lot more with credit cards and loans and things like that. Essentially, everything is impressive, right? When you go back and look at it. It's one of those companies that it's difficult to find too many things to say are the bear case, because they've executed so well. Even the strongest bear case I think you and I agree on with the company is the risk of the loan portfolio, right? And especially in that part of the world. But they've really managed that pretty successfully. They talk very openly about when they see weakness in loans and credit cards, they slow down, they hit the brake, and they pull back on issuing new cards and new loans. And then when they see things are going well, they hit the gas pedal. So they're reactive to real time conditions on the ground. So this is a fantastic business. It is doing all of the things that, it's the Amazon of Latin America. And I'm using air quotes because I hate when people say that.
Yeah.
But they really are executing that way. It's an established company. It's been around for a while. Market cap's around $130 billion. So not a tiny company, but when you consider the market they're in, this emerging market of Latin America, I could see this growing very significantly from here, especially when you look at how large Amazon has become, mostly based in North America. So I'm going with Mercado Libre for the Berkshire portfolio.
Okay, Warren, if you like these ideas, you know where to find us. It's pretty easy. I hope this helped you find some good stocks. And if you need more ideas, go to our special link again, and you can get access to the Motley Fool's 10 best stocks to buy right now. Be sure to check out that.